Good afternoon, ladies and gentlemen. Welcome to our special edition of Market Masters on what has been a historical day for Indian equity markets. We've seen a superb gap up in the market that has maintained itself so far after the stunning electoral victory of the Bharatiya Janata Party in 3 of the Hindi heartland states. What does this mean for the markets from now on? How are equity strategists understanding the play as far as May 2024, the final national elections are concerned? And more importantly, what should you be doing? All that and more will be answered by an extremely erudite gentleman, A. Balasubramanian. He's the MD and CEO of Aditya Birla Sun Life Mutual Fund and a very dear friend of mine. Bala, as he's known as, is the epitome of long-term investing. For the last 30 years, he's been with a single organization, which is ABSL Mutual Fund. He started out as a chief trader in the mid-1990s, went on to become the chief investment officer, and at the moment is MD and CEO of Aditya Birla Sun Life Mutual Fund for the past 14 years. He manages 91 schemes and overall capital of 3 lakh crore rupees, of which 1,40,000 crore rupees is invested in equities. And if you add the PMS and the offshore business of the AMC, the total under his belt is 3,25,000 crore rupees. Welcome, Mr. Balasubramanian. What a day to welcome you on business today. What a fantastic reception the market has given to the BJP's victory. How do you see it in the markets? And where is the Nifty headed over the next 1.5, 2 years from now, sir?
Thanks, Bhatnagar and Sakshi, for having me part of the discussion today. As you rightly said, okay, just a coincidence that our discussion is happening today, coinciding with the election result which came in yesterday, and also the market reflecting the outcome of election result by way of giving a thumbs up with 1,000 points movement. I think I look at this from 2 angles. One, the government initiatives, which is divided into 2 parts. One, pro-growth initiatives towards building very strong infrastructure in the country, which has been the primary driver for the economic growth the last few years, by way of investment in infrastructure, with nothing but allocation from the budgetary provisions towards building the India's future. Second is building digital India as one of the drive for the country. And third is the Make in India, which is making it more self-sufficient for the country as a whole. That's one part of it, which is more pro-growth investment which the government of India has been doing, which I call it the allocation of resources for making the India future better. The second, of course, the social benefit, which is, of course, have been one of the major driver, which largely has come in the form of a direct benefit transfer of social benefits to the large pool of people in the country. Election, of course, results is always on account of how the people at large have been the large beneficiary of the various government schemes, for which they are not only benefited, their lifestyle also is improved quite significantly. I think the election outcome, I see it as a outcome of how the social benefit also got transferred to its true nature to the benefit of large pool of people. That's why I see it. Therefore, the election outcome is a combination of both. One, the well-being of people which has been at large has been taken care by the various policies, political initiatives of social in nature. And second is making India as a very strong future, high growth country, not just only for India alone, even in the global perspectives, I think India continues to do better than what we have seen in the past. Therefore, that's also something that reflects on the market. I would say, I think equity market always looks at the mix of both social benefits, how the money is being spent effectively. That's something market always looks at it, so that the per capita income keeps growing. And the market also looks at actually the sustainability of the future, right, by way of policy continuation. Sure. And that's something the market endorses today. I would assume it is just the simple endorsement, the outcome that one, how the continuity can happen for the next 2-3 years, even beyond that.
Right. Mr. Balasubramanian, everybody who we have been speaking to, the top market experts are penciling in either up ki baar 22,000 or up ki baar 23,000. Which one are you going with?
I don't think we should look at the number. Number is only one number. 20,000 index can have come. See, nobody is expected 20,500. Because we did some analysis in the last number of years. अगर किसको भी अगर पूछा होगा what will be the index levels, all of them would have given different numbers. Either the number would have got materialized or would have maybe surpassed the numbers. The way I see at this as it stands today, I think it's not about 28,000 what we ought to look at it. I think we ought to look at for the next 10 years on the base of the strong footing in which I think India is going to do their journey for the next 10 years would definitely have a huge impact on stock market, especially reflecting the country's strength would have reflected in the market. That's why I see 22,000 is just number which could potentially come anytime even before the general election itself. I think we'll have to look beyond how the market will sustain, especially in the global space, which is what makes me confident. I think we are probably in a 10 years of bull run, both as a country, and second is on the political stability, and third is the very strong policy making which will keep coming from the government, will take the economic growth to the next level. And finally, it reflects on the corporate earnings, which is what ultimately drive the market. My own belief is corporate earnings will continue to be the driver of the Indian equity market, both as the GDP growth sustaining somewhere around 7.5%, interest rates remaining stable, and therefore corporate continues to do better as we move forward. I look at a 10-year period rather than just 1 or 2 year period.
Right. Balasa, if you look at how the market has structured itself over the last 18 months or so, and specifically over the last 6, we've had a very sharp rally in mid caps and small caps of all hues. Your own mid cap and small cap funds have been in the upper quartile when it comes to the magnificent returns that have come in. Now, from on this level, what is going to be the driver of the market? The Nifty, as you know very well, has relatively underperformed all these sectors. So where will this thrust in the market will come on? Where will you deploy the fresh SIPs that are coming in?
I think the way I see, but now the market is always go through a cyclicality in nature. I think you see some sectors performing better than the other sectors, and you'll see the broad market, which is Sensex doing better than the small cap, and small cap doing better than the Sensex or the Nifty. I think this moment of always comes is basically nothing but catching up on valuations, which actually looks cheaper than others. And second is the potential that the risk that could be seen in certain segment of the market also drive these kind of things. The way I see is from an investment point of view, definitely I think the small and mid cap cannot be ignored given the fact. I think what we are seeing in India is not about a narrow growth or narrow the policy making that's being done, which only drive only the growth in certain segment of the market. I think it's become holistic in nature. Therefore, the width and the breadth in the economic activities, if it picks up, and more Indian companies have got huge capabilities both in the engineering space as well as on the infrastructure capability is huge, whether it is automobiles, huge capabilities India has built, but all of them coming from the small size of the business model. So therefore, my own belief is small and mid cap, if India has to become $5 trillion and above, then the breadth in the market will continue to be high. But having seen a significant rise in the space in the last few years, naturally some bit of shift will happen towards large cap and in the market space. The way I think one should approach is asset allocation, I think, is the success. I think every 100 rupees, if one takes roughly about 20 to 40 rupees should go between the large cap funds and the flexi cap funds. Roughly about 20 to 30% should go towards the mid cap space, and roughly about mid and small cap space, roughly about 20% should go towards the thematic space. See, thematic space is nothing but the digital India theme remains very strong. Therefore, like banking and franchise is fun. And these are some other things I think will come. I think one looks at it, the overall model, one has to have exposure to all the three. Having said that, anybody who comes in today, for him will always worry is the past return cannot be repeated as we move forward. So what should I do? Such investors should choose actually the hybrid funds as part of the onboarding. Because there, the moment you try to actually take a call whether it should go on large cap, small cap, and impact, when the market goes through a correction in the, say, in the short term, they may suddenly start thinking that I have made a mistake and so on and so forth. Just ensure you don't get actually disappointed in the market behavior whenever it changes. I think have exposure to the balance funds, which is balance advantage fund kind of schemes, or also the multi-asset allocation fund, which invest in across four asset classes. I think would be the way to approach it. I think what is most important is actually is not about how to choose the funds. I think first be in the ring by way of investing in mutual fund by choosing multi-asset allocation fund or the balance advantage fund kind of fund. You come in, then after that you start actually moving from one to other by way of allocating towards large cap and mid cap. But having said that, we will see some bit of outperformance coming from the large cap space in the near term. But having said that, if you look at a 10-year bullish view as a country, definitely small and mid cap allocation also cannot be ignored. That should come as part of the overall portfolio allocation.
Okay. Mr. Balasubramanian, we also have some questions that have come in from a lot of our viewers. So let's start taking them also one by one. First up from Noida, Gautam Singh wants to know that is it also a time to include other assets in the portfolio like gold or real estate?
Gautam, definitely is the gold and real estate. We will probably see a temporary short-term outperformance, especially real estate sector is getting better post the wonders that has been done by the RERA as the policies came in. But having said that, I think the real power of compounding it comes in actually financial asset classes. I will probably say the fixed income asset class could be looked at it before you look at gold and real estate, given the fact that unless until one wants to have both an asset class for their future usage perspective or from staying perspectives, I think equity and fixed income, these two asset classes should become the larger component, not moving away from that. And second is both REIT and InvIT and gold is also being captured in the multi-asset allocation fund, which invest in equity, which invest in debt, which invest in gold, which invest in REIT and InvIT. Maybe that's another asset class. Probably you should look at it. And given the fact that power of compounding in these schemes is real, the power of compounding and in real estate and gold will be very small. Given the fact they don't give exceptional higher return, given the taking into account the cost that is involved, the storage value is not there, and so on and so forth.
Right. Bala sir, let's just touch upon a slightly painful topic here, which is the way the fiscal deficit is probably headed. The reason why I ask you this in particular is because you've been a fixed income trader and you understand debt markets a little more intuitively than most other people. These elections that we are seeing, it is not, it's not the party that wins, it's how it wins. We are seeing a lot of freebies being offered, to all strata of economic society. While those are necessary, they also translate into a higher cost for the government and therefore a higher fiscal deficit. Markets, especially on the equity side, are very gung-ho about this victory of the BJP. But do you think the smart guys are actually calculating the cost of this extra reveries, if I may say so, and then really wondering whether the government's balance sheet can afford them or not?
Interestingly, Nagar, the situation of fiscal is actually far better than what I've seen in the past. I think thanks to the continuous improvement on GST collections and continuous improvement on direct tax collections have been rising. And last but not the least, everyone today is more aware about paying the tax rather than actually evading tax. That's something my own belief is we'll see that the improvement happening in the as far as the fiscal concern. Second is the oil price has always been a drainer of government kitty, and the oil price staying where they are, and the import substitutes are also now being created in India. I think we have seen a significant improvement on making India more self-sufficient. Therefore, the import substitutes, I think India is playing a larger role. Therefore, the overall productivity is better, employment rates are better, and therefore tax collection also is better. So my belief is that even this recent election win has not come on the base of the social benefit scheme that they have rolled out. I think it's come on the base of the actual work that has been done for lifting the economy on one side. And second is general happiness that people have been witnessing on the benefit of the social benefits, various policies that has been government has rolled out. I think they're also being felt by the people at large, therefore it's being voted rather than any special incentive has been given for people to vote. That seems to be becoming the history of seems to be becoming the past of discussions, which in my view is not actually draining the fiscal numbers as it stands today. In my view, the fiscal deficit is getting better, is reflected in the bond market. Bond market is actually, as you rightly said, the moment fiscal slippage happens, bond market is hammered. Today, the bond market is much more stable. State government doesn't come to the market for borrowing because state government fiscal also getting better. And therefore, this is something my own belief is we are on a sweet spot as per the fiscal concern. In fact, the government of India has not been pursuing PSU divestment as one of the strategy for fiscal improvement. That itself reflects that how confident the government of meeting the fiscal target without making any adjustments on anywhere, including PSU divestment of public sector companies. And that's one of the reasons why we're also seeing PSUs are now getting more recognized in the market. We are not going to be up for sale. Probably they will be up for improving further in terms of efficiency, therefore contributing to the overall growth of the country.
Balasa, let's just touch upon another topic. Foreign institutional investors have been missing in action over the last 6 odd months as far as Indian equities are concerned. In fact, they have been huge net sellers. Given this momentum that the BJP has gathered ahead of May 2024, do you think they'll make a comeback? And if they do, what are the sectors and what kind of stocks are they going to prefer?
Sure. I think if you look at the FII's weightage for India, the MSCI weightage index, if you see, we have seen a continuous improvement. Today is almost about 16% of the MSCI weightage index is actually allocated for India. That reflects their bullishness on India. And second is, I think globally, if you go around any economy, whether it is China or other markets, I think FIIs are not able to put in money. I think FIIs have withdrawal largely on account of high interest rates which has been prevailing in the US. As we start seeing the interest rate cut coming in the 2024 in the US, as they get into the mild recessions, the interest rate will drop. I think interest rate differential between India will increase, and therefore the money will start coming into India. So that's something I see post maybe a general election or maybe pre-election. We will see the reversal of FII trend in India. Therefore, the overall balance in the market will stay. From a sector's point of view, definitely our own belief is, I think banking and financial sectors will remain one of the big sectors, given the fact that the role that they play in the broader economic growth is very high from the point of view of lending. Second is capital goods sectors will continue to be the major driver. And third, of course, is the auto and ancillaries, which largely relate to the consumption because that we are seeing in India. We will see that sector also remaining one of the sectors to stay bullish. And last but not the least, I think consumption as a sectors have gone through the last 3-4 years of consolidation. And given the fact that wealth effect in the country is rising, with the per capita income is also rising, we will probably see the spending pattern in the country is improving, therefore leading to that sector also get the due weightage in the portfolio of money managers.
Right. Bala sir, let's take one more question from our viewers. This is from Mumbai. Deepak Pal has wanted to ask you, is it the time to invest in stock markets via SIPs in mutual funds, or should one go ahead and invest via lump sum amount, looking at the market outlook that most of the experts are sharing?
I think clearly, Deepak, one of the biggest success that mutual funds have established and gain the confidence of investors to invest in the mutual fund through the SIPs. And no doubt, I will always feel that when I make a lump sum investment, the kind of rally that you are seeing in the market at times may make you feel that you have a left out. But given the fact that the market will remain, ups and downs will remain part and parcel of the market. The best way to build the mutual fund portfolio is the SIP. Even if it is a large ticket money, SIP is the best way. And given the fact it gives you a comfort that I'm investing for long term. And second, also gives you comfort not to stop your SIP, not to redeem if the market turns a little volatile. I think best way to build wealth is through the SIP. I would probably suggest maybe you can have a higher ticket SIP rather than a small ticket SIP, which is most of the people make the mistake, or maybe become conservative. Maybe if you have a lump sum money, you rather put this money but in a higher ticket SIP. So 1 year period you complete rather than keeping it for 3 or 5 year period.
Right. Bala sir, we'll take one more question here. And this question is from one of our viewers who wants to know that, okay, this is from Kanpur. Mahindra wants to know how to minimize the risks of investing in equities.
Interesting question, Mahendraji. Is definitely, of course, equity is always risky. The best way to reduce the risk on equity, the mutual fund provides hybrid funds which invest up to about 50 to 58% in equity. The rest of it is coming through the fixed income instrument. The fixed income instrument acts as a cushion on the portfolio. I think the best way to de-risk your portfolio is to the asset allocations, and which include the hybrid funds such as balance advantage fund or multi-asset allocation fund. I think we'll take care of some of the hedging part. If you are looking at a 10-year period, I think risk we'll have to keep aside, given the fact that I'm investing for 10 years. The more I look at the risk, I'll never be able to make a commitment for 10-year period. Therefore, as long as these two things we're able to differentiate, I think we'll be able to get this investment portfolio quite right from a building portfolio point of view. But I think the best way to de-risk actually through the multi-asset allocation fund.
Bala sir, I'd just like to be the fly on the wall and hear your conversation with your fund managers today morning in the fund meet that you must have had post the electoral success of the BJP. What did you discuss in terms of sectoral changes, in terms of how to approach this market, in terms of stocks that might outperform? What was the gist of that discussion?
Normally, what we do is we don't react on the basis of the market movements. I think market will always, one day market will be up, one day market will be down. I think one of the things that, of course, we keep discussing is even today, for example, the discussion was more around the outcome that we are seeing and on what basis the outcome has come, and that what the impact of this in the broad economy from medium to longer term point of view, whether it is on growth, whether interest rate movement, whether it is on any kind of policy change that could come, which could actually make the India growth far more stronger. So one of the things that came as part of the discussion is with the election outcome, definitely endorses the work that has been done by the government. Therefore, which I mentioned earlier, is the one they are voted back to the power. Which essentially means the continuity of the policy making, I think, will be more towards building the India more stronger in the future. Therefore, your conviction should also be equally high rather than getting carried away by what could happen or not happen. Second, of course, we all come back from a portfolio point of view, valuation, sector underweight, overweight. That's what we normally look at, whether we are underweight, whether we should go overweight, or maybe we should become neutral. Wherever you're overweight, whether we should go underweight, there's one conversation we always have whenever we see this kind of outcome in the market, on basis which we come to some kind of agreement and then decide the portfolio action. It's as simple as that. But of course, we don't react, generally go deeper and change our view completely. It's only reinforce the confidence that we're trying to bring and the team. Because every person in the investment team will always have a bullish and bearish view. Just reinforcement is the one something which you normally do after this kind of outcome, both on election results as well as the market.
Okay. Balasab, where are you bearish in this equity market? You know, we are just getting this cross section of happiness. Look at the smile on your face. You know, so much of money is coming in. There is a crisis of plenty, even to list out the positives in India. And at this point of time, you know, the smart guys, at least in your segment of CIOs, CEOs of AMCs and mutual funds, must be thinking कि कहाँ से पैसा निकाल लें जहाँ पर you know there is froth. So what are the areas where you see the market is over bullish and it needs to be tamped down?
I think more than sectors, I would say, I think either the sectors or stocks, they're all related to one is the market, second is the fundamentals of these sectors. I think most of the sectors seem to having good fundamentals. There's one big fundamental that has been, my own belief is very, very strong as it stands today, is the corporate balance sheet is far more stronger than the corporate balance sheet would have seen maybe about 10 years back in terms of debt to equity ratio. I think the risk could be more on F&O market. I think huge amount of participation coming from retail public at large. And if it all goes basically punt and trade in the F&O market. So I would probably suggest one is to be a little bit careful. In a bullish market, it's easy to make money. In any market which turn a little against, then the F1 market could also give you equally tough time. So that's one segment I feel that one should be careful from a larger point of view. From a sectoral point of view, of course, most of the sectors are doing well. I think export sectors, some of the export sectors, given the fact that global economy is still in the limbo when it comes to the question of growth outlook. The export sector is something have been undergoing some bit of pain period for some times, whether it is textiles or few other sectors. They may probably go through some more period of consolidation unless until we change a significant roadmap for the export to the market. Otherwise, domestic driven economy, I think by our own belief is I think we will see a significant momentum. And last but not the least is the service sectors have gone through their own period of good bull run. Again, we will see probably the service sector is going to some bit of consolidation phase for some times. Given the fact that the market momentum was driven by service sector first, then followed by manufacturing and infrastructure and capital sectors. So therefore, these kind of switch will happen. I don't see the risk, but I think the risk is actually is more of not giving return for some period of time. It will test the passions of people. Therefore, one has to be tolerant for a period of consolidation also in the market.
Bala sir, is any concern on the valuation front really kicking in your conversations that you're having at this point in time? Just a few days or months ago, we were thinking that 21,000 is a tall ask on the Nifty. Now it's just 500 points away. We're talking about 22,000 and 23,000. Is that going to be a concern that will kick in, if not immediately, in a few months?
Valuation will not kick in immediately, given the fact that in the growth outlook, if it comes in doubt, if the interest rate trend that we are currently seeing, if that comes in doubt, that the cost of capital in India is going to rise. And third, the investment that is being carried out by various companies, both in the private sector and public sector, is that going to get reduced. Therefore, it's going to actually have a dent on the overall growth momentum. Till such time that doesn't happen, my own belief is valuation remains as part of the discussion. See, valuation is something, is about how one sees it. A 22 time multiples could be costly for somebody. Somebody looks at it from a different angle. For him, 22 time P multiple is something is worth investing, right? That's the way market always looks at it. My belief is valuation always remain a concern only if the growth momentum in the economy that we are seeing is going to get derailed for a variety of reasons. As long as that doesn't happen, valuation, my own belief, will remain as a part of the discussion. But valuation, of course, comes in handy, as I mentioned earlier, that because of high valuation, those sectors or stocks may not give return for some period of time, given the fact the valuation become costly, as we have seen in the FMCG companies for almost a 3-year period. They not give any return at all for quite a number of period because their valuation is costly, their valuation getting adjusted. The valuation adjusting process could be a little painful, which is what I think one has to just take note when making investments in the market.
Balasa, there is one segment in the market that's almost running away in terms of attracting higher than percentage-wise inflows, which is the aspirational part of India. Shopping malls, top brands, where the 1-2 percentage point HNIs, ultra HNIs buy. Are those valuations in that space slightly problematic, or are they sort of talking or indicating a trend that perhaps is about to get bigger and better?
I think it's a function of the how the wealth effect is playing a role. I think definitely the high-end product, there has been some bit of challenge in terms of maintaining the same growth momentum. Whichever the product which are more mass in nature have been one gaining significant benefit. Therefore, that segment will remain more than the valuation concerns, whether they're able to maintain the growth momentum. As we have seen during that period, even this year too, while the festival season has been very good, but we didn't see the premium product getting sold as much as product was being sold at the mass level. So that's something I fully agree with you. And second is online platforms who have actually started with certain kind of assumptions with high valuations. I think beyond the point, I think when they start discovering, you'll see some of the online platforms who actually build the business model, like e-commerce model. When the public at large start moving from digital kind of model, then how that model actually will actually continue to maintain the momentum in the overall perspective. Therefore, some bit of value correction could happen. And third, of course, as we have seen significant improvement in the personal loan the last few years, I think we will probably see some bit of consolidation happening in that space. Assuming there is some discovery happens that the personal loans are not being used for the purpose of real consumptions, being used for actually speculative activities, then the system as a whole will become cagey in lending the market. Therefore, we'll see some kind of slowdown in that segment of the market, which could probably derive the consumptions kind of pattern. But I think one thing which seems to be looking better from my point of view is the fraud that was there in certain sectors like real estate sectors pre-COVID and post-COVID. And now that the fraud has been removed, I think probably the real demand supply situation seems to be more in favor of demand. Therefore, those are some of the differentiation could actually be reflected in the market as we move forward.
Okay. Balasa, between the last time you spoke to us and today, there has been one stage of the economy that's come up dramatically well, which is these digitized companies which build global world scale businesses within India, and they are valued very, very highly when it comes to secondary markets. In your own estimate, have Indian fund managers or Indian equity strategists jumped ahead of the gun? Are these valuations even at current levels justified? And where do you see this sector, this unicorn sector, this digitized world 5 years from now within the listed equity universe?
I think one good thing that has happened, Nagar, is on this sector. I think post the last year, the high valuations, which they could raise money from the market, and the market, of course, rewarding them quite significantly, have gone through its own way of correction because money manager initially build on the base of the theme that they drive. Then, as time progresses, each year, they start looking at how it's adding to the revenue growth versus profit, and how they become actually beta profit and so on so forth, profitable and so on and so forth. And second is how they remain relevant in the overall system as a whole. I think market always would differentiate those focused one on revenue growth on one side, as well as keeping in mind the improvement that should make even the profitability, so that they have to have less capital burn. They have to do the burn ratios comes down. I think these are some of the companies, well-established companies who came to the listing space last few years, and it's always going that direction. But as long as you reduce your burn rate and start focusing more on building the profitable on one side, on the other side, continue to keep your customer base increase, which is what I think most digital platform does. I think market will reward them in separately. But I think if you have to take next 5 years, given the fact that Indian millennials, the culture of smartphone usage and culture of buying and selling goods or services to the online platform increasing, we'll probably see that segment getting increased recognition as we move forward. But definitely, of course, as I mentioned earlier, one has to keep in mind the bond rate versus the both the revenue and the bottom line improvement. And these are some of the direction. If it become very, very clear, I think market will start recognizing them. But one good thing is in the last few years, especially after a few large IPOs that we have seen some bit of semblance got settled, even from money manager's point of view, not to chase companies on the base of just story, but chase this company on the base of the true potential and also remain relevant in the system as we move forward.
Balasa, we'll take one more question from our viewers. This is from Zaid from New Delhi. He wants to know from you, when is the right time to book profits in markets and how to assess how much return is actually good return?
Kya baat.
I think my own belief is it is never right time to book a profit as long as your time period of investment is long term. Second is any excess return that you have come, let us assuming scenario in the last 1 year, I got say 30% return. Believe me, the 30 will not sustain as we move forward. But in order to get 12 to 14% return, you ought to be at 30% return period also. You also have to be at say 10% negative period also. Then only you'll get that 12 to 15% kind of return in an equity over a period of time. The reason I'm using 12 to 15%, equity market generally supposed to give a nominal GDP, which is roughly about 10 to 11% plus 3 or 4% as the equity risk premium, that is the normal expectation you should have. Even today also, if you look at last 10-year return, would be in the range of about 12 to 14%. Despite seeing some sectors or some funds giving substantially higher return in the short to medium term. But that's the way I think one has to look at it. But my view, booking profit generally is not advisable unless until one needs money. At the same time, you also have a high what you call predictability that I'm making this investment for 10-year period rather than for a short period. If you have put money for a short-term period, instead of putting your money, you have a requirements coming next 1 year. You put your money in equity, you took a chance and have made money for you. Definitely, of course, you can book profit because you have the need. You don't have need, I think in my own belief is मार्केट में इतना टाइम समय बैठते रहते हैं तो उतना आपको रिटर्न भी मिल जाते हैं.
Interesting. Okay, we'll take one more question, sir, with you. And this is from another investor and a viewer, New Delhi only, Ankur Jaiswal. He wants to know from you, should one invest in the current markets in large caps or should one continue investing in the star performers, mid and small caps?
Good questions. As it stands today, I think multi-asset allocation fund could probably be the better options, given the fact that it invests in equity up to 60%. It also invests in gold and silver and REIT and InvIT asset class and fixed income. आज के दिन पे where the market is trading, definitely is multi-asset allocation fund would be more ideal. I think large cap is also becoming one of the options, given the fact that small and mid cap are outperforming the market big time. Only to diversify risk, the large cap and multi-asset allocation fund could be an ideal as it stands today.
Right. Balasa, we are drawing to a close of this wonderful conversation, but let me take this opportunity for our wider set of audience as also all the new investors who are joining this wonderful bull market that is unfolding in front of us. You've been in the market for 30 years and obviously there have been ups and downs. You've learned a lot of things and unlearned many of them. What has been the basic takeaway in your life over the past 30 years? 3 good points and 1 bad one.
Of course, one, my belief is one, you have to stay on course because the industry will go through its own challenges. I'm talking about broad industries levels. We will see challenge will come and hit the economy. But I think if you stick to your conviction that yes, that longer term you will only keep seeing improvement. Therefore, that's something one has to stay invested. Second is you have to continue to have your faith and optimism that yes, I think as a country we are doing the right things. Therefore, that's something you have to reinforce your confidence on the economy. Otherwise, making money in the market is difficult, or you cannot stick to one organization for long unless you have the conviction and optimism that you are in the right place. And third, of course, is the asset allocation is something which is key. Sometimes we may get carried away looking at returns, but I think what is most important, sustainable, is asset allocation from a longer term point of view. Something which, of course, where one should not get worried. Sometimes we do make mistakes. I think in every time, all of us have been in the market, have made mistakes. As long as we realize from the mistakes and basis which we don't make the same mistake for the future and take that into as a lesson. And as long as we realize that lesson we have learned by these mistakes, and that mistake is something doesn't haunt you or maybe drop you back from taking a decisions, is something I would say is a lesson that one can take.
All right, we'll just take one last question with you, sir. And this is from one of our other investors too. And he wants to know from you, how should one investor, okay, this is Sudhir Pegwar from New Delhi. He wants to know, how should investors evaluate the risk and the return profile of a mutual fund?
Because I think risk is something, if you go with the theoretical book knowledge, definitely the various definition could be given like standard deviations and beta the portfolio and so on and so forth. I think my view is, I think these are all too complicated, too more organized. The only way investors, my belief is, you can manage the risk is the asset allocations between asset classes within the equity. If you are conservative investors, you look at only the large cap and balance advantage fund kind of things. And if it is moderate investors, you choose a little higher risk And if you're aggressive investors, take a little higher risk of investing in small and mid cap. That's the only way you should measure your risk. Where every investor is not the same as when it comes to the question of taking risk. And that depending upon your ability to tolerate the volatility, your ability to put more money, your income levels also will determine your risk-taking capability. Therefore, if we put in the three buckets, are you a conservative investors, moderate risk investors, or aggressive risk takers? I think we put in three buckets. I think it become much easy to actually take the decisions, even when you put money in the mutual funds. When you put money in mutual funds, of course, I have seen every 3 years somebody has done exceedingly well, but not necessarily they will continue to do well. Because every fund will go through their own pain period. I think what is most important assessing the risk is whether the fund will actually be a long-term player in the industry and stay on course. Despite all the volatile period that the individual will go through, as a fund will go through, as long as you have the conviction that they are here for long term, on basis which I think take a bet, not taking a bet on the basis of the short-term return is substantially higher. The bigger mistake that one should never do is chasing the return is something will actually make you feel disappointed when the reversal happens. Therefore, I'm a firm believer to never chase the return because of returns are pretty high. I think just focus only on asset allocations.
With that, Bala sir, this wonderful 40-minute chat draws to a close. Thank you so much for spending your time with us and discussing the future roadmap of the Indian equity markets post this stunning electoral victory of the Bharatiya Janata Party in the Hindi heartland. We'll remain in touch with you, and hopefully from now on, we'll see you more often on Business Today television.
Thank you, Bhatnagar, and thanks to Sakshi for having me part of the show, and look forward to seeing you again.
Okay. So that, ladies and gentlemen, was Mr. A. Balasubramanian. He's the MD and CEO of Aditya Birla Sun Life Mutual Fund and manages 3 lakh crores over 91 schemes. The broad thrust of this conversation was that he believes that the structural bull market in India will get stronger from now on because of policy continuity, as also corporate earnings and political stability. With that, this show draws to a close, but remain glued to Business Today television for all your financial news needs. From Sakshi and I, thank you so much for your time.
Thank you.